$82.50. That's the number that broke the internet this week. Not Bitcoin. $82.50 was where Strategy's flagship preferred stock, the one Michael Saylor once called his company's iPhone moment, bottomed out before clawing its way back into the high 80s. And while that was happening, Bitcoin itself slid all the way towards $64,000, dragging the world's largest corporate Bitcoin holder right along with it. So here's the question everyone in this space is whispering right now, and some are shouting from the rooftops. Is this finally it? Is Strategy the company and Saylor the man, staring down the kind of unraveling that ends careers and empties balance sheets? Or is this just another brutal Tuesday in the life of the single most polarizing trade on Wall Street? Before I go one sentence further, a quick disclaimer, because this is the kind of topic where people's actual life savings get involved. Nothing you're about to hear is financial advice. I'm not your financial advisor. This is not a recommendation to buy, sell, or hold anything. And Strategy, STRC, and Bitcoin are all genuinely volatile, genuinely risky assets. Please do your own research, talk to a licensed professional if you need one, and treat the next 20 minutes as information, not instruction. Welcome to the Wealth Continuum, the channel where we try to connect what's actually happening in the markets to what it actually means for the money in your pocket. If that's the kind of thing you're into, the subscribe button is sitting right there, and it genuinely helps more than you'd think. Now let's get into it, because there is a lot to unpack today, and I promise that by the end of this video, you'll understand this story better than most of the people currently arguing about it online. Quick favor before we dive in though, drop a comment and tell me where you're watching this from and what the weather's doing on your end right now. Are you somewhere sunny with this playing in the background while you do 5 other things? Or are you locked in, full focus, genuinely trying to figure out whether you should touch any of this with your own money? I actually read these, so tell me the truth. Okay. Here's where things stand as of today, the 21st of June, 2026. Bitcoin is trading somewhere in the $63,000 to $65,000 range, well off its all-time high near $126,000, which was set back on the 6th of October last year. Strategy's common stock, ticker MSTR, has been crushed down somewhere around 70% over the past 12 months, currently sitting in the low 100s. And Stretch, ticker STRC, the preferred stock strategy market's almost like a high-yield savings product, fell to a fresh all-time low this past week before bouncing. Sentiment across the entire Bitcoin community is, by most measures, sitting near its worst point in years. So the bears are out, they're loud, and a lot of them are convinced this is the beginning of the end. Let's actually look at why fairly and honestly before we get to the other side of the argument. Real quick, because not everyone watching is fully caught up on how Strategy's capital structure actually works, and you'll need this to follow the rest of the video. The company funds itself through 5 separate tickers: MSTR, the common stock everyone talks about, and 4 distinct classes of preferred stock: STRC, the Stretch product we've been discussing, alongside STRK, STRF, and STRD, each carrying its own dividend rate and its own place in line if anything ever went seriously wrong. STRC sits closest to a cash-like instrument, which is exactly why its wobble matters so much more than the rest. It's the piece being marketed hardest to everyday, ordinary retail investors as something boring and safe. When the most retail-facing piece of this entire puzzle starts cracking, that's the piece that generates the loudest headlines, even when the rest of the structure underneath it is holding up just fine. Here's what they're not telling you in the headlines, though, so stay with me because the details actually matter more than the panic. Point 1. Stretch has genuinely broken its peg, at least temporarily. STRC is designed to trade right around $100, its stated par value, through a variable dividend rate that adjusts month to month to keep buyers interested. This past week, it touched an intraday low near $82.50, its worst print since the security launched last July, before recovering into the high $80 range, where it's trading today. That's more than 10% below where it's supposed to sit. And here's the thing the bears love to point out. Strategy has raised that dividend rate repeatedly since launch, trying to hold the line. Right now, it sits at 11.5% annualized, but because the price has fallen below par, the effective yield for anyone buying in today works out closer to 13%. When you have to keep sweetening the deal to keep people from walking away, that tells you something about demand. Point 2, the credit markets have already passed judgment, and it isn't kind. Back in the fall of 2025, S&P Global handed Strategy its first ever credit rating as a Bitcoin treasury company, B-, 6 notches below investment grade. Officially, unambiguously, junk. And independent of any rating agency, the free market is essentially agreeing. STRC's effective yield right now is brushing up against 13%, which puts it above where even the riskiest junk bonds typically trade. The market isn't waiting for an analyst to tell it this is risky. It's already pricing it that way. Point 3, and this one's genuinely important if you want to understand the whole machine. For roughly 4 years, Strategy's stock traded at a fat premium to the actual Bitcoin sitting on its balance sheet, sometimes 2, 3, even 4 times the value of the coins themselves. That premium is what powered the entire flywheel. Issue new shares above the value of the Bitcoin backing them, use the cash to buy more Bitcoin, watch the Bitcoin per share number climb, repeat. As of the middle of this month, for essentially the first time since Strategy became a Bitcoin company, that flywheel has reversed. The stock is trading at something like an 18% discount to the Bitcoin it actually holds. Every new share they'd issue right now would be selling $1 of Bitcoin for roughly 80 cents. That mechanism, the one that built this entire empire, is currently running in reverse. Point 4. The dividend bill doesn't go away just because the stock price did. Across all of Strategy's preferred securities, the company owes something in the range of $1.5 to $2 billion a year in distributions. In late May, for the first time since the company began accumulating Bitcoin back in 2022, Strategy actually sold some. 32 coins, worth about $2.5 million, specifically to help fund Stretch's dividend payments. In the grand scheme of a holding north of 800,000 Bitcoin, that sale is genuinely tiny, a few thousandths of 1% of the total stack. But symbolically, it was a sledgehammer because Michael Saylor had spent years insisting, publicly and repeatedly, that this company simply does not sell. The moment it did, even at this microscopic scale, it gave the bears exactly the headline they'd been waiting for. Point 5. This one rattles people just from the sheer size of the number. In the first quarter of this year, Strategy reported a net loss of $12.5 billion, almost entirely driven by unrealized losses on its Bitcoin holdings under newer fair value accounting rules that force the company to mark its Bitcoin to market every single quarter, whether it actually sells anything or not. On top of that, filings over the past several months have shown a pattern of company insiders, including some directors, trimming their own personal stock positions during this stretch. None of that is illegal on its own, and executives sell shares for all kinds of ordinary personal reasons. But when a company's own people are quietly reducing their exposure while everyday investors are being pitched the stock and its dividend products as a stable way to ride this story, that's the kind of detail the bears latch onto. And honestly, it's a fair thing to want explained. And point 6, the one that gets passed around social media the most right now, though I want to be careful and honest with you about it. There's chatter online, some of it from accounts claiming legal expertise, suggesting that marketing Stretch to retail investors is something resembling a stable, savings-like product, while the underlying funding mechanism shows real cracks, could eventually invite scrutiny or even litigation. I want to flag clearly that this is speculation circulating online, not a confirmed legal action. And these kinds of claims are notoriously difficult to actually prove in court. I'm not going to pretend it's more certain than it is, but it's part of the bearish narrative right now, so you should know it's out there. So that's the bear case, laid out as fairly as I can manage. Real risks, real numbers, nothing fabricated. And look, I understand why the mood feels close to apocalyptic right now, especially if you've been in this space a while and you're already a little worn down by it. But before that mood makes any decisions for you, it's worth remembering that Bitcoin has been declared dead, dying, or about to fall apart more times than anyone could possibly count by genuinely smart, genuinely credentialed people going back well over a decade. Almost every single one of those calls eventually got quietly walked back or simply never brought up again once the price recovered. That doesn't automatically make this time different, and I'm not telling you to ignore real risk just because of it. But it is worth asking yourself a genuinely uncomfortable question. What if $63,000 right now ends up looking 2 years from now? The way $3,000 looked back in late 2018, or the way $16,000 looked in late 2022? Both of those moments were treated as the end of the story at the time. Neither one actually was. But here's what they're not telling you on the other side of this story. Hit like on this video right now if you've ever held something through a genuinely brutal, stomach-churning drawdown, because we're about to get into why some very smart people are looking at this exact setup and seeing the opposite of a death spiral. Let's talk about what the bulls are actually pointing at, because their argument has just as much real data behind it. First, scale matters. The bears keep skipping past it. Strategy raised something like $25 billion in fresh capital last year alone, making it the single largest issuer of new equity among American public companies for 2 years running. Even in the ugliest stretch of this current downturn, the company is still pulling in real money through stock and preferred offerings. In some recent weeks, over $100 million on individual trading days. That is not what a funding mechanism in total collapse looks like. Second, let's actually do the dividend math properly, because this is where the bear case starts to wobble. Strategy's total annual obligation across all its preferred stock runs somewhere around $1.5 to $2 billion. If, in the absolute worst case scenario, the company had to cover that entire bill purely by selling Bitcoin at current prices, it would need to part with something like 18 to 19,000 coins a year. Sounds like a lot, until you remember the company is sitting on roughly 846,000 Bitcoin, something close to 4% of every coin that will ever exist. We're talking about a little over 2% of the total pile annually, in the worst possible case, where literally none of the obligation is covered by ongoing capital raises. That's a leak? Sure, it is not a flood. Third, the cost of capital argument actually cuts both ways. Yes, paying 11, 12, 13% to borrow against Bitcoin sounds expensive on its face, but Strategy's own average purchase price across its entire holding sits around $75,600 per coin, for a total spend just north of $64 billion. Bitcoin's long-term historical growth rate, averaged across full market cycles, has comfortably outpaced even that double-digit dividend cost. If that trend holds even loosely going forward, the company doesn't need a moonshot. It needs Bitcoin to grind modestly higher over time, and the dividend obligation essentially pays for itself. Fourth, look at the scale of the drawdown in proper context. Bitcoin's all-time high, just under $126,000, was set on the 6th of October last year. We are sitting today, more than 8 months later, somewhere around $63,000 to $65,000. That is a drop of nearly half from the peak. And if you go back through every major Bitcoin cycle since this asset started trading, a pullback in that 50% neighborhood, in the middle of an otherwise intact long-term uptrend, is not some unprecedented disaster. Historically, it's closer to the norm than the exception. There's also the matter of timing within Bitcoin's broader four-year rhythm, something this asset has followed loosely but consistently since its very first halving event. Bitcoin's most recent halving, the moment block rewards paid to miners get cut in half, happened back in April of 2024. Historically, the 12 to 18 months following a halving have produced some of Bitcoin's strongest stretches, and the period that follows that initial surge has tended to bring exactly this kind of brutal, multi-month drawdown before any next leg, if there is one, gets underway. None of that is a guarantee. Cycles can and do eventually break, but it's part of why a lot of longer-term holders aren't treating this particular drop as unprecedented. They've quite literally watched this exact movie play out before, more than once. And fifth, Wall Street hasn't actually abandoned this trade, whatever the headlines might suggest. Analyst price targets on Strategy's stock right now span an enormous range, from around $200 on the more conservative end, up past $450 on the bullish end, with the average sitting somewhere between $310 and $350. TD Cowen reiterated a buy rating just days ago with a $400 target. Citi remains bullish too, even after trimming their own number down to around $260. None of these are guarantees. But it's worth noting that the institutions closest to this trade haven't thrown in the towel, even as the stock has been cut nearly in three. And there's a sixth point worth adding here too, sitting just beneath the surface of all this. Despite a wave of headlines about exchange-traded fund outflows over the past month, somewhere in the neighborhood of $6.25 billion pulled out of United States spot Bitcoin funds over the trailing 30 days. The structural plumbing connecting Bitcoin to traditional finance hasn't actually gone anywhere. Pension funds, asset managers, and corporate treasuries that built positions over the last couple of years are still holding. Outflows during a drawdown are normal portfolio behavior during a scary stretch, not proof that the entire institutional thesis quietly fell apart overnight. If anything, periods exactly like this one tend to separate genuinely long-term holders from people who were only ever along for the ride on the way up. And if you're the kind of person who actually wants to understand market-moving stories instead of just reacting to whatever headline lands in your feed, subscribe right now, because what I'm about to walk you through next barely got any real coverage anywhere else, and it might be the single most important piece of this entire puzzle. You need to understand this next part before we go anywhere else, because it might honestly be the single most important piece of this entire story, and almost nobody covering strategy right now is talking about it properly. For months, a huge chunk of the bull case for Bitcoin, and by extension for strategy, leaned on one specific assumption: that a new Federal Reserve chair would quietly turn dovish, start cutting rates, weaken the dollar, and send risk assets like Bitcoin flying higher. That new chair has a name, Kevin Warsh, and he was confirmed by the Senate on the 13th of May this year, in the closest, most divisive vote for a Federal Reserve chair in American history, 54 to 45. He was sworn in on the 22nd of May, and a meaningful slice of the bull community spent the following weeks practically counting down the days to his first meeting, convinced that underneath a hawkish public reputation, he'd secretly cut rates the moment he got the keys to the building. That first meeting happened on the 16th and 17th of June, just days before this video went up. And I need you to sit with what actually happened, because it did not play out the way a lot of bulls were hoping. The Federal Reserve held interest rates exactly where they were, in a range of 3.5% to 3.75% by a unanimous vote of 12-0. The rate hold itself wasn't the shock. What rattled markets was everything around it. The Fed's policy statement got dramatically shorter, and it stripped out language that had previously signaled future rate cuts. Worse for anyone betting on a dovish surprise, the committee's own internal projections, the so-called dot plot, showed the median expectation for interest rates by year's end actually moving higher to 3.8%, up from 3.4% back in March. 9 out of 18 voting members are now penciling in at least one rate hike before the year is out, not a cut. Chairman Warsh himself notably declined to submit his own personal projection at all, which some read as deliberate restraint and others read as simply not having made up his mind yet. The market's reaction told you everything you needed to know about how that landed. The Dow dropped roughly 500 points that day. The S&P fell over 1%. The 2-year Treasury yield, which moved sharply on Fed expectations, jumped 16 basis points in a single session to 4.21%, its highest level in well over a year. The dollar had its best single day in nearly 12 months. Gold dropped more than 2%, and Bitcoin, already wobbling, took another leg lower right alongside everything else. On top of the rate decision itself, Chairman Warsh used that very first press conference to lay out a much broader agenda for reshaping how the Federal Reserve actually operates. He announced 5 separate task forces covering monetary policy communications, the underlying data the Fed relies on, the size of its enormous balance sheet, productivity, and the causes of inflation, with most of that work expected to wrap up by the fall or by year's end. He's also talked openly about shrinking the balance sheet faster than previously planned and cutting back on the number of scheduled policy meetings and press conferences going forward. None of that is dovish behavior. It's the opposite. It's the behavior of someone trying to establish inflation-fighting credibility first and worry about the market's reaction to it second. So here's the uncomfortable truth sitting right in the middle of this entire story today. The one thing a huge slice of the bull case was quietly counting on to flip the whole script, a dovish new Fed chair riding to the rescue, simply did not show up. Not yet, anyway. Inflation is still running hot at 4.2% annually as of May, driven largely by an energy shock tied to the conflict in Iran, and Chairman Warsh made it unmistakably clear at that very first press conference that bringing inflation back to 2% is, as he put it, the unambiguous priority. Does that mean the bull case for Bitcoin and strategy is finished? Not necessarily, and this is the part that keeps me up at night thinking about this trade, honestly. Futures traders are still pricing something like a 60% chance of a rate hike, not a cut, by October. But that number swings hard with every single inflation print. If the energy shock fades, and there were already some signs of oil prices easing before this latest flare-up, that headline inflation number could roll over within a couple of months, and this entire calculation could flip right back in the bulls' favor just as quickly as it flipped against them. But as of today, the savior a lot of people were banking on turned out to be more hawk than dove, at least on his opening night in the job. So where does that actually leave us? Honestly, exactly where situations like this almost always leave us, with a genuinely split picture and a lot of very loud people on both sides pretending it's simple when it isn't. The bears have real documented points, stretched trading meaningfully under par, a junk credit rating from a major independent agency, a stock now trading at a discount to its own Bitcoin for the first time in company history, a real dividend bill that has to get paid one way or another, by new capital or by selling coins. None of that is invented, and none of it should be waved away. But the bulls have real points too. A capital-raising machine that, even in the worst conditions in years, is still pulling in genuine money. A dividend obligation that, in the absolute worst case, requires selling a little over 2% of the total holding annually. A Bitcoin position equal to roughly 4% of everything that will ever exist, bought at an average cost meaningfully below where Bitcoin still trades, even after this entire drawdown. And a roughly 50% pullback from the all-time high that, viewed against the full history of this asset, looks a lot more like a normal, painful stretch of a longer cycle than the opening act of some unprecedented collapse. Now, I genuinely want to hear from you because this is exactly the kind of situation where the comment section actually teaches me something I didn't already know. Comment below if you think Saylor and Strategy make it through this stretch in one piece. And here's a question worth sitting with for a second after you do. Strategy's Bitcoin holdings, bought at an average price of around $75,000 a coin, are currently worth more than the entire company's stock market value at $64,000 Bitcoin. What happens to that math and to every bearish headline currently circulating the moment Bitcoin simply gets back to $94,000, the level several analysts have flagged as the point where the company's Bitcoin holdings alone would mark a brand new all-time high? Type your honest answer below. Bullish, bearish, or genuinely somewhere in between. I actually want to know where you land. If you want to actually see how this plays out instead of just absorbing whatever the loudest voice on social media says next, subscribe, because we're going to keep tracking this story closely right here on the Wealth Continuum, including the moment the next Bitcoin update drops, and the moment Chairman Warsh next opens his mouth about interest rates. One more thing before you go. If this video actually helped you understand what's happening instead of just adding to the noise, share it with the one person in your life who keeps asking you what's going on with Bitcoin and strategy, and somehow ends up more confused every time someone tries to explain it to them. That's genuinely one of the more useful things you could do for them today. Thanks for spending 20 minutes of your day here with me. I'm signing off from the Wealth Continuum. I'll see you in the next one.